And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. As always here, now money's been pouring into ETF funds this year. We know that. Plain vanilla ETFs getting enormous amounts of money coming into them. But now we're seeing something potentially new and different. Let's talk about that. Over the weekend, Dimensional Fund Advisors has converted 4 of their mutual funds into ETFs in the largest ever conversion from mutual funds to ETFs to date. Let's talk to Dimensional Fund CEO Gerard O'Reilly and Dave Noddick, Chief Investment Officer at ETF Trends. And Gerard, you're the mastermind behind that. You're talking about nearly $30 billion in mutual funds, 4 of your mutual funds converting into ETFs. Just briefly explain the rationale behind doing this, because this is the biggest one that's happened to date, and potentially you're going to be a leader doing this.
Yeah, thanks, Bob. It certainly was a big weekend for us. We're very excited about the conversion over the weekend. When you look at these 4 mutual funds, Bob, they have a long and strong track record. They go back almost 20 years, some of the mutual funds that we converted. And they were all managed with an eye towards tax management. So they have tax management in the name, and tax efficiency is part of their objectives. And so what that means is that the investors in these strategies, think about after-tax returns, think about tax efficiency. And so while they've done a very good job in terms of maintaining high tax efficiency ratios, in fact, similar to many ETFs out there, this ETF wrapper gives us an additional tool to help achieve the investment objectives and increase the tax efficiency ratios of these strategies. So that was a big driver behind why to convert these mutual funds to ETFs, Bob.
You know, Dave, Gerard likes to say he's wrapper neutral. In other words, he manages money, and if it's in an ETF, fine, a mutual fund, fine, whatever. But we're interested in the ETF business, covering that. And Citigroup had a great report out last week saying dimensional conversion of the mutual funds into ETFs will provide some kind of benchmark for having this happen in the future. I'm wondering what your thoughts here. Will it push a lot more of the mutual fund industry? It's 21 trillion, something like that, into the ETF. Is this going to be another accelerant?
I think it has to be, right? I mean, first of all, congratulations, right? I mean, I think it's a monumental day to see this large a conversion. But I think we have to recognize this is a fairly narrow product set. These aren't funds that are in 401ks. That would make it much more difficult. They're not actively managed funds that really rely on non-transparency. That's a whole nother discussion. So there's a bit of a Venn diagram overlap where I think these funds are in a real sweet spot for conversion. They're also funds that now investors can get access to. I mean, historically, it's been a little tough to get access to some dimensional funds unless you had a dimensional approved advisor who could help you do that. Now anybody can get access to these, what are great strategies, very, very tightly managed strategies, great trading under the hood. So I think it's a great sign, but I'm a little skeptical that somehow $1 trillion is going to follow suit. We know that a lot of active managers like to keep their trading private. There are different structures for that. And a lot of the mutual fund industry is very focused on the 401k industry, and that makes conversions really difficult.
Yeah, but what about that, Gerard? I mean, you've been very successful. I look at the money flowing into some of these that are already out there that you've had, the 3 or so you've already had out there that are in ETF space. You've attracted a lot of money. That's very attractive to get people out there who might not have been in your mutual funds before or qualified or had a platform, as Dave mentions, to go in there. The ETF wrapper, besides the tax advantages, does have that advantage. You can bring in a lot more people, potentially.
Yeah, Dave hit on a couple of great points. And one of those points is that when you look at that Venn diagram that he mentions, where these funds are managed with an eye towards tax management, when you think about Dimensional's approach to investing, it has a lot of benefits of indexing. You know, it's low cost, you have broad diversification, low turnover, but then a lot of the benefits of an active implementation, whether it's the trading under the hood, consistent focus on the asset category. So a lot of those things put us in a real sweet spot, and these funds in particular in a real sweet spot to have this conversion kind of go through successfully and make a lot of sense for the shareholders in the strategies. I do think that when you look at the ETF landscape out there, it's 99% index approaches on the equity side. And what this brings and offers investors is a systematically managed strategy that you can observe its live track record for some of them over 20 years in all types of market environments. And I think that's somewhat unique to the industry. So we're very excited about being able to offer this, and in that kind of tax-efficient wrapper, which will, I think, benefit the investors in those funds. And in particular because, there's a lot of talk and concern about what might happen to tax rates going forward. So for those folks that are kind of thinking about that, tax management can be important.